Hello, everybody. Good morning or afternoon or evening, depending on where you are. Couple quick housekeeping things. We will be sending out the recording of this webinar at the end, and we will also be offering the slides, and everybody will have access to the report as soon as it's available, which will be early next week. You guys all get early access. We also have the Q&A open, so feel free to ask any questions along the way. Russ will answer everything as he goes and at the end. And for those of you that don't know, Russ is not only our co-founder, he's our CEO. And in addition to being a multi-time founder, he's also an angel investor and has mentored a ton of startups through the fundraising process. And he is here to tell you about the anatomy of a Series A round. Take it away, Russ.
Awesome. Thanks, Andrea. And welcome, everyone. Thank you for joining. This should be a fun one. So I'm going to switch over here and start sharing my screen. Okay, so as Andrea said, we're talking about the anatomy of a Series A raise. And one of the reasons that we do this research is, back when I started my first company, Preseed, I went around asking for advice on fundraising, and all the advice I got was like super anecdotal. It was like, well, this is what I did and it worked, so you should do that, or this is what I did and it didn't work, so you should probably not do that. And that was just frustrating for me because I was like, yeah, but doesn't someone have like a larger data set? And when I talk to investors getting their advice, the investor view is just totally different than the founder view. We've probably all been to conferences where there's the panel of investors basically giving founders advice on like how to get money from them, but that's never real, in my opinion. That's their view on it, but it's really different. So that's what motivated this. This is real research from real companies that have used DocSend to raise their series A and have opted into being part of this research. So before we kind of dive into it more, just a little bit of background on myself. So as Andrea mentioned, I'm a CEO and a co-founder at DocSend. This is my second startup. The first startup was called Pursuit. We raised a seed round for it and then ended up selling it to Facebook as a talent acquisition, which on the one hand was, a success, but on the other hand, I, didn't create a real company there. Before that, my background is in computer science, so mostly been a product manager at places like Microsoft, Trulia, Dropbox, Graystripe, and Facebook, and was at Stanford for undergrad and grad in computer science, and I went out to Harvard for an MBA. So, we've done a bunch of different research on different topics. So if you haven't seen it yet, go check it out later. We've got pre-seed, we've got seed, we've got Series A. We also even have research on how venture capitalists do their own fundraising. So believe it or not, venture capitalists have to fundraise, and a lot of them use DocSend for that as well. And we're focused on the Series A. And it's actually worth checking out these other topics because it, believe it or not, is like super different, like pre-seed versus seed versus Series A, both in terms of like how people order information, how long it takes, how much money is involved, what's critical for them, where investors spend most time and are the most discerning on your pitch. So go check those out. So for those of you who aren't aware, DocSend on the surface is just a really easy way to send a link instead of an attachment. And you get a lot of great properties on top of that link. So it's secure. Every VC you send the deck to, it's a new link. You get to see how long they're reading each page, and you can see if they forward it to their partners or not. And then you can see an aggregate, across your whole pitch deck, where people are spending their time. You can also have allow list, so they can't forward that deck externally, and they can't download it. You can dynamically watermark things, and you can create data rooms of material. So like everything in one spot. Because typically you'll send your pitch deck. If the VC likes it, they'll take the meeting, and then you'll need to, if you're moving through the process, you'll need to send them more and more files, especially for the Series A, and DocSend is a place you can kind of put all those files together. And specifically what we're looking at here is the pitch decks that are sent to get you the meeting, because that's where you see like the most drop off. And that pitch deck is like really critical just to get the meeting. In terms of like DocSend as a company, we've actually got over 15,000 customers. We get used in a lot of different use cases: sales, marketing, customer success, CFOs, M&A, banking, kind of all over the place. Fundraising is near and dear to my own heart, though. Just it's something I've had to do a lot of, and I've helped a lot of people with it. And it's one of those things where I always say that talent is evenly distributed, opportunity is not. And more it's changing that you're able to start a software company anywhere, not just Silicon Valley. And so I do think access to this information around like how do people raise successfully is just really needed to help spread that opportunity like more widely than it is spread today. So as I mentioned, this is all opt-in data. The way it works is that if someone is using DocSend to fundraise for a Series A, we'll send them an email automatically afterwards because they're basically self-identifying saying we're raising a Series A, send them a link being like, hey, do you want to participate in this research? And if they say yes, then they fill out a big survey and they also give us access to their kind of document analytics and their pitch deck. And so then using all that information, we anonymize it and aggregate it. That's the basis on top of which we are able to do all this research. And what's interesting to me is that this is just a bigger data set than anyone else has. So there's still a ton of variance in it and everyone's journey is different, especially as you get to later and later stages of fundraising. But at least we're able to pull out some like aggregate, like this is what it looks like, because fundraising is scary. So any information is better than no information. So there are a couple of things that are just kind of like general pieces of advice, and these are more personal than they are kind of rooted in the numbers. But for fundraising specifically, it's one of those things where you want to work smarter, not harder. So if you're in sales, if you just pick up the phone a few more times, you just work harder, you're going to get something done eventually. So hard work really can pay off. For fundraising, if your pitch is off, if there's something wrong, like you might talk to hundreds of investors and still not be able to raise money. So that's why I say it's a work smarter thing. You really have to be open to feedback. You have to be open to change, and you're going to get a lot of no's. And so sometimes you have to ignore them, and sometimes you have to really listen to them. And that's a tough balance to have, but it's important. So keep that in mind. Be open to feedback and be open to changing things. The second thing I'll say is that fundraising is really hard. There are a few different factors that kind of make it seem less hard than it is. Like one is the companies that successfully raise, even if it was really tough for them, there's no incentive for them to be like, I got so many no's before I got a yes. They're not like, there's no benefit to them saying that. And then the companies that try to raise and fail, that's embarrassing. It's really painful. They don't want to go around being like, I failed. So basically all we see are the TechCrunch stories of like company magically raises Series A and you're like, oh, good for them. They're so lucky. But on the back half of that, there's just there's a lot there are a lot of like no's that are happening and there's a lot of frustration that's happening. So keep that in mind. And so you want to surround yourself with friends and family. Tell them you're going through this so they can be just nicer to you while you're going through the process. And this is also why I say that it's important to try to get to yes or no as fast as possible. And we'll discuss some of the tactics and ways that you can give yourself the best chance of succeeding here. All right, so let's take a look at some of the first numbers we're going to look at. So these are only successful Series A decks. These are ones that actually were able to raise successfully. Those decks on average were 25 pages. So these are just the decks that are sent to get the meeting, the pitch deck. This doesn't include all the data room material or other things. Those pitch decks, 25 pages on average. 3 minutes and 11 seconds is the average investor view of a pitch deck, which is not that long for 25 pages. There's a lot of just flipping through there. And 20% of the views are on mobile phones, which is not a huge number, but it's significant. So if you've got a page with a lot of density on it, someone's gonna be on their phone, like pinching and zooming and trying to read, and they're probably not gonna bother. So these are just some things at a high level to keep in mind when you're thinking about like, what have other people done in successful decks? What should I do in my deck? Like keep this in mind. If your deck is like 50 pages, that is way too long. If you're like, oh, my deck is only 4 pages, that's probably too short. So all things being equal, kind of aim for this. I would say 20 pages is, in my opinion, the right length. Part of that is because a lot of people include an appendix in their send ahead, and I don't like including an appendix in the send ahead. But that's also something we can cover a little bit later. Okay, average Series A raising process. So this is just US only, but 50 investors contacted on average. It's a huge number. There's also a ton of variance here. Some of the companies that I've helped raise a Series A or been a part of, they only talk to like 4 or 5, sometimes only 1. Like for DocSend, our Series A was preempted, so I actually only talked to 1 investor. Other people talk to 100, 150. So there's a lot of variance here. But what you should keep in mind here is that this is going to be a process where you have a spreadsheet, you have a lot of investors, and you're going to be trying to get a lot of warm intros. You know, it's not going to be like, oh, I emailed 3 investors and got it done. That happens. It's just not that common. So on average, this is kind of what we're looking at: 26 investor meetings. And this includes repeat meetings. So if you need to talk to an associate, talk to a partner, talk to the partner meeting, that would be 3 meetings that you would have there. So what you're seeing here is that most of those investors you're contacting are not actually going to meet with you. So you get a lot of no's, even for those who are successful. Average is 8.6 million raised and 22.5 weeks on average to close, which is a long time. It takes a really long time. So when you're budgeting for, like, usually by the time you get to Series A, you're burning money. So you have a runway, you have a cash out date. So you got to manage this well, like plan in the future. Like, it's going to take you a while to fundraise, and you do not want to be running up against the wire for, oh my God, am I going to run out of money before I raise my Series A? That just puts you in a horrible negotiating position. And so, if you're kind of wondering, well, how much should I ask for? 8-9 million for a Series A. That's like pretty typical. Interesting to note that we had a lot of data from other countries as well in here, and the average Series A internationally was like a little over 2 million. And what that tells me is that globally, we have not standardized around like what is a Series A. And so I think if you're thinking about like a Silicon Valley, like typical Series A, it's 8-9 million bucks. If you're in another country and you raise 2 million and you want to call that your Series A, that's totally fine. But it's a little bit different in terms of the dollars involved and probably the investors that you're talking with as well. Okay, so this year has been a tough year in a lot of different ways, and one of the things we've been tracking in real time has been the average time spent on pitch decks. Right, so we had that 3-minute 11-second number. Like, how's that been evolving this year? And what we've been seeing has been that fundraising activity is at an all-time high, not shown here, but investors are looking through a ton of decks. Founders are sending a ton of decks. Because it's an economic downturn, there are a lot more people starting companies. And so you both have existing founders that are out raising, and then you also have all these new founders that are raising. And the VCs can't hop on a plane, they're not going to conferences, so they're just sitting at home and they're reading a ton of decks. So now is still a great time to raise money, but what you're seeing is that investors are just getting much more efficient at reading through these decks. And one of the things that accounts for this much lower time spent is that there are a lot more 20 and 30-second like visits where an investor will flip through to page 5, they're like, and then they just bounce. They don't even get to the rest of your deck. So this year, more than ever, it's really critical that you have a great and easy to understand narrative in your deck, and that varies by company. But the attention spans are going down this year. And if you lose someone early, they will not get to your best slides on page 9 or 10 if you lose them on page 5. So this again is take feedback seriously. Try to make it a very clean narrative and be open to like changing things around, because if you don't, you're going to end up getting a lot of no's that could have been yeses, and you won't even know why. They just won't respond, or they'll just say not a fit, and they won't even go through your whole deck. So one of the other things that is a question I get asked, it's like, well, what's the difference between a Series Seed and a Pre-Seed and a Series A? If I were to like roughly like categorize the rounds, Pre-Seed is either you've got a really strong team or you've got like kind of a minimum product, like you've got the product. Pre-Seed is all about, can you build the product? Like, and then when you get to seed, where you're raising, a couple $1 billion, typically that's about like, do you have some signs of early traction, even if it's anecdotal, but have you been able to build the thing? Are people using the thing? And then Series A, when you're asking for like $8 or $9 million, like you do need to have a lot more evidence that this is a real business. So it doesn't need to be like, a money-making machine. Like, I've got this marketing engine, if I dump money in, I get more money out. That's the Series B and beyond. But for Series A, you do need to show that there's a repeatable business. There's much more emphasis on like, it's a great product, you've got a great team, you've got some people using it. Show me that this is a business that can scale. So you don't have to have proven your unit economics, but you need to have shown that you're thinking about them and you're thinking about this as a real company. And so that also means having clarity on your go-to-market motion. Are you enterprise? Is this self-serve? Is this B2B2C? Or like what exactly is your go-to-market strategy here? And so know that going into creating your deck. Like that's a thing people are screening for, and it's a thing you need to spend serious time thinking about, not just for fundraising, but also because you do need to create a repeatable business. Like, it's not fun to work on something that's not repeatable, and it's not fun to work on something that's not scaling. So you and your potential investors are aligned that that's something you need to have a good answer for. Another thing that's really important in the Series A, it's important in all rounds, but it's especially important in the Series A, is have a good narrative. One of the common mistakes I see people making is that they try to make what they're doing seem more complicated in hopes that they look smarter. So they might start from, oh, our defensible moat is blah, 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 or, oh, we've got a network effect. But I don't necessarily care as an investor what your differentiation is or what your defensibility is if I don't understand what your business is. So you have to start with the business first, and you have to have a clean narrative around that. So the person needs to be able to repeat what you do to someone else. So especially for the Series A, it's not just the partner that you're pitching that you need to convince. They need to convince their other partners. These firms typically make decisions like jointly, and so whoever's going to go to bat for you is going to need to go to the partner meeting and say, hey, I just found this great startup. Here's what they do. So at the end of your pitch, ask someone to repeat back to you what it is that you do. If they're struggling to repeat back to you what you do, that means you need to make your narrative cleaner. And you can get to it later on where it's like, oh, and here's how it's defensible, or oh, here's how it scales, or this is interesting, like a network effect that we can have later on. But don't start with that. That has to be secondary. And so really focus on nailing the narrative first. So another thing is that product never goes away as something that's really important. Like in a Series A, there is more emphasis on your business. It's scalable. Like this is a real thing. However, people still need to see how you do that. Like you still need to have some focus on what your product is. You probably don't start with it. It's not like, here's the product. But in there somewhere, it's a really critical component. So 73% of successful decks included product slides. And something I definitely recommend, especially if you're using DocSend, is put animated GIFs or videos in your deck. Animated GIFs are especially great at being able to make your product come alive in a way that makes it seem more real to investors. And again, just like with your narrative, you don't need to show all of the complexity around it, but you need to show enough to get someone excited enough to be able to take that meeting and want to dig deeper. And kind of on a related note, for your first meeting with a Series A investor, it's, in my opinion, never a great sign if they ask you to walk them through the deck, because they just read your deck. So it's much better if it's a discussion. They're like, actually, I'm excited, but I have these questions in this area. And it ends up being like kind of a furious debate. That in my mind is a good sign that they're excited. Oftentimes to actually close the deal, you need to pitch the partnership, and pitching the partnership often does require you walking through your deck for all the other partners. It's that in-person pitch, but that in-person pitch is really an end of the funnel set where they're like pretty sure they like you enough, and you need to just kind of show that you're a good public speaker. This correlates to a lot of things, being inspiring, be able to hire people and stuff like that. But where most people like fall off is like the pitch deck that gets in the meeting, and that first meeting that gets that partner to go back and like sell you to the rest of the partnership. And product is a big part of that. So something that you have to tee up in your Series A is repeatable traction, because that is what is needed for Series B. Series B is really about like, hey, we've got a money-making machine. I'm going to raise 15, 20, $30 million to just like really grow this. And for a Series A investor, what they're looking for is how likely are you going to be able to raise your Series B? How big of a company could this be? And so you don't need to have proven repeatable traction, but you need to show that you're thinking about it and it's possible for you. You might have line of sight to it. So it could be showing, if you're kind of a product-led growth company, just all the reviews that you're getting, on G2 Crowd, or it's showing pipeline if you're doing outbound sales, or it's showing like close rate, or it's showing just really big net retention amongst a small number of customers, but you're like, this is repeatable because it's so sticky that the LTV is huge, and therefore I can spend a lot to acquire more customers here. You'll be like, that makes sense. That math is great. and you're like, I've only done it for this many, but if I do it for like this many, then that's where we can just like start to really scale the thing. Repeatable traction means something different depending on what your company is, and so it really varies. I do think for the Series A, it's worth going off and talking to 1 or 2 Series B investors if you can finagle a meeting. And again, you're not pitching them to raise money. You're just asking them, hey, if I raise my Series A and this thing starts to work, what would you want to see for the Series B? And that might help you hone in on like, what are your metrics for repeatable traction, and like, what's the early evidence that you could put into that Series A deck to show it's possible for you later on. It's also a nice way to build relationships for your Series B when you get there later. So scalability is also very similar to repeatable traction. There's the old joke. It's like, well, sure, we lose 50 cents on the dollar, but we're going to make it up with volume. And it's like, no, that's not a good idea. So like whatever your unit economics are, like if they're not positive now, you need to have a story for why they will be positive, and why like in the limit, like this ends up being profitable or just being a good business. And it's totally fine early on to do things that aren't scalable, to get growth, to be scrappy, to like put it together. But for Series A, you need to start thinking about scalability and being able to speak to it. So just keep that in mind. Like, don't be caught off, on your heels if someone asks you about, how is this product scalable? You might change your mind later about what the right answer is, but you do need to have an answer for what you think is most likely going to make what you do scalable, and why it's going to get easier over time. So another component here is just around the Series A is something you need to tee up. So if you're listening to this and you're just doing your seed round, or you had just done your seed round, like you really have to plan ahead for the Series A. And your seed investors will be able to make introductions to you to Series A. You might be able to start building your list and reach out to some of those people, even though you're like, hey, I'm not raising now, but want to have a quick chat with you and tee it up for the future. I think it's a good idea. You want to be a little guarded on terms of the metrics that you share with someone, right? Like, so you can say, oh, we're not discussing revenue. Revenue's not the focus. Like, we're focused on building the product and the team. We're focused on early traction. So they're going to be trying to get numbers out of you, but you don't have to share. Like, it's up to you. They're not going to like not talk to you later because you didn't share all your numbers with them. If anything, you want to make sure that they're just excited about your narrative, and then when you come to them for the Series A later, they're then excited about your traction, whatever that means for your company. But start thinking about the Series A early. Like, congrats, you just raised your seed round, ta-da! Start thinking about your Series A, because in 18 months or even in 12 months, you're going to have to go out there and start raising for it, and it happens a lot faster than you think it will. So especially about picking a seed round investor, but it's also true for the Series A. You really want your seed investor to use their prorata in the Series A. And what that means is if you have a lead seed investor, a very common term is prorata rights, which means that the seed investor can invest more at the Series A so they don't get diluted down by the Series A. There are super prorata rights where they could invest even more. That's not very common, but prorata rights are common. But often a Series A investor will ask, like, are the seed investors using their prorata? And what they're doing there is they're basically asking, are the seed investors still excited about you as a company? So if the seed investors do not use their prorata, it can make the Series A investor very cagey and less likely to invest, which is horrible for you as a founder. So make sure you know if your seed investors would use their prorata, because you don't want that to be a surprise. And in 88% of these successful Series A companies, their previous investors participated in their Series A round, meaning that they used their prorata rights. And this is also something you can use as a screening mechanism. Like if you have multiple term sheets, or in the conversation with your seed investors saying like, what criteria would you have to use your prorata rights? You can also ask your Series A investor that. Like, hey, for the Series B, like what do you want to see from me in order for you to use your prorata rights? Because it just continues in the future that like as soon as people stop using their prorata rights, it's going to make that next investor even more nervous, and it's just going to make your job harder as a founder to raise more money. Also for Series A, this is the first round where it's not just the pitch deck. For pre-seed and seed, it's usually just the pitch deck. For the A, you still need that pitch deck in most cases, but you also have more information to share about traction, about customers, about growth. And so instead of trying to put everything in your pitch deck, like all the appendix slides and stuff like that, what most founders do is they end up creating a data room. It doesn't have to be a huge data room, but it can be a collection of like your pitch deck, like maybe customer lists, logo walls, like product collateral, a bunch of links to like different articles that have been written about you to show social proof. And so you're going to have something that has maybe 8, 10, 15 assets in it, like web links, Excel files, like PowerPoints. And in DocSend, we call that a space. And so just know that going into Series A, you're probably going to be asked for like more information. So get out ahead of that, maybe create some of those assets ahead of time and have a way to be able to share that in a single link with the partner at the firm you're pitching, because that partner needs to then share that with their partners. And if you have a bunch of attachments across emails, you just kind of look unorganized. And you can always use like a Box or Dropbox link, but that's not going to give you the control or the analytics that you want to see, like, did they forward this to their partners or not? That's a really good indication of, are they serious or not? If they said they did and then they didn't, don't pin your hopes on that investor. They're probably not as serious as they led you to believe. So another difference between seed and Series A is the team slide. So in the pre-seed and seed, the team slide is just the team slide. It's just the one page typically. For Series A, the average is actually 2 slides. So it's closer to 2 than it is to 1. And so what's happening is that for the Series A, it's no longer just you and your co-founders. Like, you've got a team. You've got a team of people behind you that are doing the real work, building this thing. Like, who are those people? Are they the right people for the jobs? Like, how do you think about your team, building your team? How impressive is your team? So you can, I would say for Series A, like, just assume you're going to have 1 slide on your founders and you're going to have 1 slide on your execs, or just more about your team. Like, hey, we've got really awesome engineers from Google, or hey, we've like got a really awesome go-to-market leader, or we got this like awesome like sales team. Whatever it is, like, this shows your ability as a founder and CEO to be good at hiring and retaining great people, because that's a hugely important skill for you being able to go the distance. Like, let's just say, okay, awesome idea, awesome product, awesome traction, but this person cannot recruit and retain people. Like, that's your company is going to have a hard time with things. So investors are really looking for that as well. Investor is really important. So if you're lucky enough to have multiple Series A investors that are interested, like, how do you pick? It's also worth noting that only 3% founders did not have a lead investor. Like, if you're raising $8-9 million, you basically almost always have a lead investor. There's someone who has a fund that's going to write you a big check, because otherwise you can't put that together with 50, 100K checks, even from like super wealthy people. It's just too hard. So you're going to have a lead investor. They're going to get a board seat. And the number one reason people pick their lead investor is that person has industry specific experience, which doesn't seem like rocket science. I'm like, yeah, sure, that makes sense. However, like, if I told you that most of them came through a personal referral, maybe that would make sense too. So this is why it's nice to have data on this stuff. So it's not the first offer, which is also interesting. Only 4% said first offer. So this is around where you can be more patient. Like, just because it's the first term sheet, don't necessarily jump on it. If there's another investor who you think knows your industry better, wait for them, let them know you've got a term sheet, see if they'll come to the table too, because that's the person you want. You want the person who knows your business best, who's going to be the most helpful for you going forward. The second one is offer the best terms. Again, like, maybe you got 1 term sheet, if this other term sheet comes in, it's going to be a lot better terms, like, wait for that one. That's a common tactic that Series A investors will use, is to move quickly, but maybe give you a lower offer, hoping that you take it now, versus, having to pay up or making it competitive, and then it makes it a lot more expensive for them. So kind of other ones on here, got along best is kind of in the middle. The only term sheet is also in the middle. So if you only get 1 term sheet, don't stress, just take it, move on, build your company. It's fine. Name brand, pretty far down the list. Again, it's like, you're going to have to build this company. Does the name brand of the investor really matter? Not really. What matters more is that the partner you choose to work with knows your industry and is going to be a good partner to you in building your company. This is very much like a marriage. You never get rid of your Series A investor. Not that you necessarily want to, but if you run into a spot where it's a bad relationship, you're really stuck. You're really stuck in it. So be very thoughtful about who you're picking to be on your board and to be your lead investor for your Series A. So in terms of like what to expect from an offer, like how much are we giving up here? On average, founders give up 20% of their company, and then they do an additional 10% for an employee option pool. And this doesn't mean it has to be a full 10%. If in your seed round, you put in place a 10% option pool, let's say you only use half of it, then you only add another 5%. So you kind of like top it off to 10%. But if you don't have an option pool, then what you're looking at on average here is you are giving up 30% of your company for this round, because the way it works is that the investor gets 20% and they make sure that you have an option pool, and that option pool is taken as dilution for you and your previous investors. So it's like kind of taken before they get their 20%. And so I see founders sometimes like try to optimize for like, oh, it's too dilutive, I only want to do 10%. Like these are just kind of industry standard numbers. So the way I think about it is like, how much money can I get for giving up 20% of my company? You know, like what's that check size? And so that's like $8 or $9 million bucks. Great. You know what, if you want to like save on dilution later, just make that money go further, like make more progress before you have to raise again, or maybe just don't raise again. But don't fight it in terms of like, I'm only going to give up 5% of my company in the Series A. It's just less common, and it's probably going to make things harder for you. And then also worth keeping in mind is you got another 5.5 weeks between closing and actually getting the money wired to you. And that has to do with there being diligence in the Series A. That's a big enough check that people have questions and they want to make sure, like, are your contracts real? Like, is everything as you said it would be? So just budget a little more time there before you get that money in your bank. So don't cut it too close in terms of like your runway and time to cash out. So just doing a quick summary here of if nothing else, some takeaways for you. Number one, start early. You should be building potential Series A relationships, you know, in your seed round or around there, because 50 on average, that's a lot. So have your favorites, have 5 or 6 that, you know, you're not like a new face to them and you've at least had a conversation before. Have all your materials ready. So like do some prep work going into this, like anticipate questions, like have like Excel files ready, like know what people are going to ask, you know, have all your contracts and things that are put together there. Third, tell your story. Everything we talk about in the details is not important at all if you don't have your narrative right. So tell your narrative cleanly and clearly. It is often the case that great companies are simple to describe, and that's okay. You don't have to make what you're doing seem complicated. In fact, people who are experts in their field, in my experience, are really good at not making you feel dumb. Like they're able to describe to you microbiology and like whatever their area expertise is, like pretty cleanly and well. And you know, investors are good at sussing that out. They also don't like feeling dumb. So if you're making an investor feel dumb because you're trying to make what you're doing sound more complicated in order to make yourself look smarter, that's not, in my opinion, a great strategy. So focus on your story. So 3 more takeaways here. Sell your vision. Like, where is your product heading and why? So those are those product slides. Like, what does this become in the future? So it's not just like repeatable traction and scalability, but like, what is your vision for this? And is this really a big idea? Like, there are a lot of great ideas that just aren't venture scale companies. So if what you're working on is venture scale, could be like a really big company, make sure you're selling that vision. And of course, you have to both sell your vision and do this next one, repeatability. It's like, oh, great, you're going way up here. What have you done to get where you are now? Can you keep doing it? Like, can you prove to me that it's repeatable, or at least, you know, sell me on it being repeatable? So that's something you're going to have to do. And the last is plan ahead. This takes a long time. You have to be doing a lot of pitching, and just make sure you're not stressed about money. Like, plan far enough out that you can like make progress, or like manage your burn such that you like allow enough time to go pitch to this many people to raise your Series A. So we've got a great a newsletter. So I would recommend everyone to sign up for that. Great anecdotes, great stories, like advice from investors and other founders. And then this is all part of what we call the DocSend Startup Index. So check it out on our website. We have a lot of like interesting resources, real-time data on what's going on in the fundraising market. And then just a little bit about like why we have this data and how DocSend is used. So again, Spaces, awesome data room. You know, your choices are kind of like, you know, a box folder or interlinks. Interlinks is way too expensive. Box folder doesn't give you the insights and analytics that you want. So DocSend is a great use case for that. We've got another feature called the Collaborator Model, which is really important. So if you're at a company that has a sales team, so you're using DocSend for your sales team and you're using DocSend for fundraising, you can actually have two separate accounts that you link together so you can switch between them. That way you're fundraising in a different DocSend account than you're using for your sales team. And this is a common thing I would like make sure people know they can do. So that way it just keeps it cleaner. Like it can be you and your CFO and maybe one of your investors that's helping you out on like your fundraising DocSend account, and then you and your sales team and your VP sales on your sales account. And then just in case you're curious, like things that are up next for us, like we're coming out with a full e-signature product at the end of the year. So across our 15,000 customers, we're like, yeah, everyone's got a HelloSign or DocuSign account. Like that should just be a DocSend. So we'll have full e-signature by the end of the year. Keep an eye out. It's going to be really awesome. It's going to be really clean, and it's going to have like great analytics and be totally integrated in with our data room product. So especially for sales teams, this will be a game changer. And then just some additional metrics. We have the real-time kind of weekly interest metrics, like how many founders are fundraising, how many investors are looking at decks, like how much time are they spending on them, especially going into an election or looking at things post-election. This will be an important thing to keep an eye on, so you can kind of know, do I want to raise now or not? Like, well, what's the fundraising market doing? How active is it? How likely would I be to raise? Network, it only applies to pre-seed and seed at this point, but if you submit your deck, we can match you with lead, pre-seed, and seed investors. It's pretty straightforward. And if it's also worth noting that only 20% of the decks get accepted. We have a pretty high bar for it, but that's kind of needed in order to have trust with investors. So even for the decks that we reject, we give a bit of advice or feedback on it and a score. So it's definitely better than nothing, and it's free. So there's no downside. And then as I mentioned, the pre-seed report and the seed report, go check out the other research that we've got, really interesting takeaways on all those topics. All right, I'm going to switch over to some Q&A questions. Let's see. Okay. Okay, is there really that much difference between seed and Series A? What if we don't fit in either category very well? We're more of a sapling than a seed, but not quite a mature company. Yeah, this happens all the time. It's like, what stage am I? To be fair, like for DocSend, we've really been trying to break it out and to define the stages. But the way I would think about this is that investors themselves have arranged themselves by stage. So for instance, if you're a seed fund and you've raised $100 million seed fund, you've made promises to your investors, your LPs, around like, what check size am I writing? How much equity do I want to get for that? And then how many of those deals do I want to do such that this is the fund performance? So if you're Jeff at Uncork, for instance, and that's his business model. So if you're asking Jeff for 200,000, that's too little. That's not a range for him. If you're asking him for 5 million, that's too much. That's a different stage. So he really focuses on those like $1 million to $2 million check sizes and kind of split that with other co-investors. For Series A, if you've got like a $300 million fund or something, you can't go and ask them for 500K or $1 million. That's too little. But you also can't ask them for a Series B amount. So the investors that you're talking with dictate how much money they would want to give you. So the question for you as a founder is like, okay, how much progress have we made? And based on how much progress we've made, how much money do I think I could raise? Because how much money is this thing worth now? A lot of it is baked into growth rate. A lot of it's baked into revenue progress. So if you're not sure what round you land at, you unfortunately just need to go get some advice. Go talk to some Series A investors, talk to some Series Seed investors, talk to some other founders. Founders are a great resource. And just kind of like, if you the founder talk to you, it's like, hey, here's what we got. Like, what do you think we can raise? Like, what range, what round? Like, what do we call that? Who should I talk to? That'll kind of help steer you in the right direction for having those initial conversations. How many meetings per VC? So the standard would be you meet with a junior partner or an associate. So you send your deck, you get an intro, you send your deck, they look at your deck, they say, yeah, I'd like to meet with you. Meet with an associate. Then the associate's like, oh, yeah, I like this. This makes sense. They'll go pitch it to one of the partners. Then the partner will want to meet with you. Partner's like, oh, okay, makes sense. And then the partner will go talk to their partnership about it. Sometimes there are like a few meetings with that partner in there. If it drags on too long, it's not a great sign. So hopefully it's just the one, talk to the partnership says, yeah, and then you go in and you meet with the partnership, you give them your whole pitch, and then they get back to you with a term sheet or a no. So 3 to 5 meetings probably for a VC to get to a yes. For Series A, it's typically not 1, and it's probably not going to be 10. That means they're just dragging their feet and they're not able to have conviction quickly. So it's going to be somewhere in that range. Any distinction that is important between an A and an A1. So this kind of brings up the whole topic of bridge rounds. And bridge rounds are becoming increasingly common, but they're really not a spot you want to get yourself into. It's just not, it's not a great spot to be in, because you're saying we've made some progress, but not enough progress. And there just aren't that many funds that focus on bridge rounds. And if you raise a bridge round, it can often be a down round, which is really bad. And there just aren't, yeah, the world, you look different. Anything you do that makes you look different from other companies is a risk area. But you find yourself in the situation that you're in. And so if you need to go raise an A1, just kind of know that it's going to be harder for you and you might have to take more dilution. It might, maybe you just open up your Series A again. And so you raise a smaller amount of money at that valuation, which is dilutive. But if that money helps you like survive, then that's great. DocSend, we actually did something called an A1 round, but it was unusual in that it was very much an up round. So it was like twice the valuation of the previous round. It was just a smaller amount of money. So we only raised 5 million. But that's because we had a specific need around what we wanted to use that money for. And so you do have control, even though you have the average round kind of being this size, like depending on like who you talk to, like there are more options. In our case though, it wasn't a round we went out and like pitched a bunch of people for. It was just a kind of a personal relationship where I'd been keeping someone up to date. And then we were able to get that round done on like reasonable terms. So again, yeah, if you're gonna raise an A1, this is some part of your job as CEO is to be social, to keep up with investors, to like network, like in that way, like the more of a known quantity you are, the more likely you are going to be able to raise money when you need to, especially if you're kind of on the cusp. You're like not an obvious like hockey stick yes. I am at pressed and one GC says, I actually don't know whether that and what that question means. Sorry. Are companies better off naming a cap or leaving it to investors to make an offer? So that's why I like this research. It's kind of industry average. If you ask different founders, they'll definitely have different answers. And fortunately, the answer is really, it depends. For Series A, one of the things I like to do, phrase it so that you're not negotiating against yourself, is to say to an investor, like, hey, I know we need at least like this amount of money. I know we need at least like $3-4 million. But if we can, we probably want to raise more than that to give ourselves more runway. The way I would like you to approach this is that we would like to give you 20% of the company if you're interested in investing. How much money are you interested in giving us for 20% of the company? And you see what they come back with as an offer. And again, because you have the numbers in this research, you kind of know what market is, at least in the US. And so you kind of know if they're trying to undercut you. And in order to get the best price, you basically have to have multiple term sheets or the threat of multiple term sheets in order to bid that price up. I would strongly suggest not going with the best terms though. So if you get an offer from someone and they're who you really want to work with, use that term sheet to get a better offer, and then go back to the original person that you like better and have them match those terms, or have them get as close as they can. But then you're getting the partner that you want at something that's close to the best offer you got. But don't pick the best offer just because it's the best offer, because remember, you're getting married to this person and you're going to have to work with them for many, many years. Are Dragalong rights a concern in Series A negotiating? I actually don't know specifically what Dragalong rights can mean a couple different things. You typically, after you sign the term sheet, when you're coming up with a definitive agreement, that investor will be looking at your other terms. And if you have 2x liquidation preference from your seed round, your Series A is going to want that term as well. So it's really hard to like get rid of terms going forward. They're like, well, you agreed to it then, you should agree to it now. So yeah, like it's a slippery slope. Once you give an investor a right, they typically, all future investors will get that right. And so yeah, people will try to do sneaky things with you. So it's really important to have a good lawyer. You can get a seed round done. You still need a lawyer to close it. But for the Series A, like make sure you have a real law firm and someone who's done this before. You don't want it to be your family friend lawyer who is in a different area of law. You need, like, we use Fenwick. They're phenomenal. Love Fenwick. But they're going to be able to tell you what's normal, what's not normal. And it's expensive, but if you're raising $8-9 million, it's absolutely worth it. How would you recommend drawing up a hit list of potential investors for Series A and then getting introduced to them? I mean, it's all online. There's like, Crunchbase, you can look for Series A. There are a bunch of different tools out there. I mean, you can also just like go around asking other founders, like, who do you like? You raised from this firm, or the any other firms you'd recommend? And you just kind of have to piece it together. At Series A, it's not, the world is smaller than at Series C. There are just a lot more seed funds than there are A funds. So you can put together a list of 30 to 50 firms, and then the thing that's a lot of work is trying to figure out warm intros to them, or someone who's a trusted party to forward your deck to them. That just always works better than cold outreach. Hopefully your previous investors can also help. This is absolutely a responsibility of your previous investors to help you both build this list and then get intros to this list. And I do it all the time, where I have someone send me a deck and ask me to forward it to our Series A or other investors, and I'll often do that, and it looks reasonable. So it's just time consuming for you. And during the pandemic, it's unfortunately been the case that founders have had to contact even more investors, and the number of meetings has gone up. To that question earlier, like how many meetings do I need? Like, building trust is a little slower, and so you might have to have more meetings, and you might have to contact more investors in order to get your deal done. Does DocSend have any data integrations that enable founders to incorporate Google Sheets, Google Analytics data into the deck? No, we don't allow visualizing Excel files, but you can put Excel files into DocSend. They're just download only. So you'll see if they download them, but almost always people need to download the Excel files. And then in terms of like visualizing things, as I mentioned earlier, animated GIFs are a great way to make things come alive in your document. So that's why it's typically a mix of like decks and like Excel files that you're putting in your data room. Okay, if you recently finished raising a seed round on a convertible note and have less than 10 months of runway, what would be your strategy for your next fundraise? I.e., do you think it's enough runway to successfully do a Series A, or would you recommend a Series Seed? Well, so if you did a seed round on a convertible note and you have 10 months of runway, the question is like, how much progress do you need to make before you think you can go out to market and raise a Series A? That's the real question. And I would recommend leaving 6 months of runway when you start your Series A process. So that means you only have 4 months to make enough progress that you think you can go out and raise your Series A. So that's a pretty personal decision around how close do you want to cut it. And if you did raise a seed round like that, I don't know if that would be an extension. It'd probably be at the same cap, but just more money. It's going to convert at some point. It's also possible that you can just keep adding to your seed round because they're convertible notes. And so maybe you can give yourself another like 5-6 months of runway with just more notes. On a kind of related topic though, I often recommend for the seed round, if you can get a lead investor, just price the round. If you're raising $2 million, just price the round, pay the lawyers to convert everything into equity, because then, and also create a board, like have a board with board meetings. Like it's often scary for founders, but having a board and structure actually makes you more likely to be able to raise a Series A, because you just look like you have your act together more, and those investors feel more invested helping you get your Series A done. So, again, there are multiple opinions on how to do this, but that's just my opinion, that if you can structure it that way at the Series Seed, it's helpful for the Series A. GIFs only work in PowerPoint. Can you do this in Keynote? Yeah, Keynote is just, Apple is just on its own planet over there with Keynote. I know it's prettier. You can actually export PowerPoint and then give it to DocSend. So that's one workaround, but would love to support Keynote and animate GIFs at some point, but probably not in time for your next fundraise, unfortunately. Do you have any data on revenue amount? Still 1 million ARR or millions of users? What % are raising Series A pre-revenue? Oh man, this one's also all over the map. It depends on your business. The question is like, what evidence do you have that what you're doing is really important? And then what's the best way to represent that evidence? An investor who immediately gets focused on revenue is not a great sign, because again, you're pretty early raising your Series A. And again, this also comes back to narrative, like what's the narrative on what you're doing? And it could be the case that given your narrative and given what you're building, what's really important is to have these 4 customers that are just really sticky. They're great relationships and you're showing awesome net retention. Because you're like, we can do it with 4, we can do it with more. And then it's like, well, how much revenue is that? Like, well, revenue is not that important here, and nor is the slope of the revenue. What's important is like the stickiness with the customer. And so you're kind of guiding the investor to like the data that you have that makes you look best is the best data that indicate that you could be a big company. So, you know, and very rarely is it that your revenue is the best indicator, because if your revenue is the best indicator as a company, don't even raise a Series A, just keep building your business. Like, it's a great business. So typically then it's some other metric, and it could be like millions of users, but again, like that's pretty uncommon. So it's usually some sort of like mix of like product metrics and engagement metrics, like quotes from customers, that sort of thing. But you know, often if you're like B2B SaaS, like yeah, some amount of sales is going to be important there. But remember, the better your narrative, the easier, like the less emphasis and pressure there is on having great stats. If you have a crap narrative, but like a hockey stick revenue thing, fine. But you should also just have a great narrative that, and then like, it's just purely better if you have a good narrative. Have you seen investment memos widely used on DocSend? So investment memos can mean a couple different things. There is kind of this old school notion of a business plan, which is like not really what happens anymore. It's typically just, you know, the deck is the new business plan. Investors will have an internal process often where they create an investment memo. And so you'll need to turn on downloading so they can download your deck, maybe give them the PowerPoint version so they can actually munge things around and mix and match. Because they'll often put together a document that they share with their partners that summarizes why they think your company is so exciting. And it's in their words, not yours. And so that investment memo. We don't see that many firms use investment memos in DocSend just because it's a partnership, it's trusted, they've all been working together for a really long time. So the partner sharing it is like not necessarily that concerned with security or tracking, because the person knows their partner meeting on Monday, everyone needs to read it ahead of time, they're gonna have a discussion about it. So not that often, but it is good to know that you might need to help your partner write a good investment memo about you, or give them enough information to arm them to go pitch you to their partners. Just knowing how that process works is helpful as a founder. Let's see, how robust does an MVP have to be to have a successful A round? Oh, it depends on your category, like how robust, but the answer is like very robust. Like you need to have people really using your product and vouching for your product, and your product needs to actually solve problems. The pre-seed round, you might be able to get by without that much of it. Seed round, you really do need like an MVP in almost all situations. And then Series A, it's like, are people paying for your product? You know, it's like you've got a launched thing with a marketing site, and it's you know, early, but it looks pretty real. So I would think about, you know, the seed money you're raising, that needs to be invested in product such that, you know, you have a really strong product going into your Series A. And that again will just look different depending on what it is that you're building. Is it okay to show a range for Series A ask 12 to 18 million and share milestones we can achieve? I haven't seen it done that way, because the way you're phrasing it is like, if you give me this much money, I can get to this spot. If you give me this much money, I can get to this spot. And more often than not, the way investors are thinking about it are, you know, is this a venture scale company? Could this be a really big company that returns the fund? And they have their own check size range. They have opinions about it. And if they're the only bidder, and they know they're the only bidder, they'll probably try to get a better deal. If you have multiple parties interested, or you can at least insinuate you're going to have multiple parties interested, they're going to be motivated to give you a market rate, and they kind of know what a market rate would be. And so that's kind of outside your control. So sure, you can ask for a range, but usually it's like, I need to raise at least $5 million. But again, like anything you're sharing is kind of negotiating against yourself, and you don't really want to negotiate against yourself if possible. But yeah, sometimes people just ask you for a number and you feel compelled to give it to them. And then the less complicated you can make it, the better. You know, we really need 10 million. Can we get by on less? Sure, but 10 million is going to help us get here. And it's probably not the case that if you raised 15 right now, you could get even further. That's just more dilution than you need to take. Like, just kind of decide what number you want and then raise again later, like once you've kind of gone past those milestones. Is DocSend Series A pitch deck publicly available that you use for the fundraising? No, it's not publicly available. I'll ask our team if we could share it, but we raised our Series A many years ago. And that one was preempted. So again, I didn't go out to market. August Capital was the only firm that we pitched for a Series A, and Howard has been on our board ever since, and he's been fantastic to work with. So ours was a little unusual in that sense as well. Although I did have to go through the process of pitching Howard, showing Howard my deck, and then going and pitching August Capital and the partner meeting there, like standing up in front of everyone, like going through my deck. So it did fit in that sense. But a lot about our business has evolved since then. What's the technical definition of a bridge round? I'm not sure there is a technical definition for a bridge round. A bridge round is kind of like an oh no round. It's like, okay, so we raised, let's just say 10 million out of 40 million pre for our Series A. So it's 50 million post, and we gave up 20% for that. Or even let's just say 2 million seed on 8 million pre, so give up 20% for that. And now, okay, we raised 2 million seed, and I don't think we have the traction or made progress enough to raise a Series A. So, but I think I'm pretty close. It's like another, like not working at all. Then maybe you just, pivot, try something else, see if you can sell the thing. But if it's working enough, and you're like, it's just so close. Then a bridge round is saying like, okay, it's going to be less than typical Series A, like pricing and terms, and I'm going to take less money, and it's going to be a lower valuation. But I think with that, I can actually make it to the Series A milestones. And so that's what people talk about. It's like a bridge to somewhere. I need this money to get to very specific things. And there is more pressure for you to show with a bridge round, like this is the progress we've made, like this is where we want to get to. And often a bridge round is done by your insiders because they're motivated to help you, right? Because they're already invested. And so often it can be led by an insider and with maybe a couple outsiders participating in it. But if your existing insiders have no interest in giving you more money, it makes it really hard for you to go out and raise a bridge round from some new investor on the outside. So I would say just try to avoid getting into a bridge round scenario if possible, but it happens, and then you kind of have to do the best you can as a founder to get your company enough money to make it and succeed, and managing costs is often a big component of that as well. Well, thank you everyone for coming. This has been really fun. We'll definitely do more of these in the future, and so many great questions in here. I apologize, wasn't able to get to more of them, but this is great. So everyone enjoy your day, and thanks again.